Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 115, we're going to continue our theme of the last few days of diving into the particular transfer taxes that apply on a federal level and looking at those from a broad, kind of policy-driven level, but understanding the why behind these taxes. We're going to close out this year, 2020, with a general understanding and discussion of the federal generation skipping transfer tax. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And I want to caveat again that the views in this presentation are solely my views and do not reflect actual policy documents or research. This is really designed to show you how I explain estate and generation skipping transfer tax to clients and students. So, as we've wrapped up our discussions on gift and estate taxes, I mentioned that they're unified in that they operate together to kind of cumulatively tax your transfers of wealth, whether those occur during life or at death. And they're designed to be applied once per generation. However, somebody could intentionally make a transfer that skips generations, such as maybe giving assets to their grandchild, which would remove one layer of gift or estate tax. Now, this is designed to only be a downstream transfer to younger generations. The IRS doesn't really care about upstream transfers as much, so if you have a living grandparent and you make a transfer to them, then even though you're skipping a generation of your parents, you're not necessarily going to be subject to the generation skipping transfer tax. You're not going to be in the category of taxpayer that the IRS intends to capture here. So, the generation skipping transfer tax is designed to fill the gap of any skipping of generations as you go through younger generations, but it's imperfect because it only applies once to a transfer. So, for example, if you had a great-grandparent making a transfer to a great-grandchild, and even though that skips 2 generations, the generation skipping transfer tax would only apply once. And, like with the gift tax, this is only designed to capture intentional skips of a generation. So we have the same gift tax exclusions that apply, and we have a deceased parent skip person exception, which I've explained in a previous episode, which will prevent you from having this type of tax in a case where you have no choice but to skip a generation because the generation you're skipping is deceased. Now, in general, I've covered this tax very broadly in a number of past episodes in terms of the mechanics, but we'll summarize to just mention the features that I covered in those previous episodes, being that the GST tax applies in addition to gift tax for lifetime transfers and in addition to estate tax for transfers at death. So, even though we have a separate gift and estate tax that are broken down by lifetime versus death transfers, the GST tax applies in all those spheres. Now, the biggest issue when it comes to the GST tax is timing. So for a direct skip, in other words, a direct transfer to skip person or skip persons, a tax is immediately generated and is due immediately. However, for indirect skips, there's no way to know how much might go to a skip person unless there's a taxable distribution or a taxable termination. That would be the case if, say, you fund a trust where multiple generations are beneficiaries currently or in the future. So because the GST tax might apply at some point way down the road in the future after the gift or estate tax has been applied to the same transfer, what that means is that there's a GST exemption that you apply at the time that the gift or estate tax applies to the transfer. And what that does is it affects the rate of tax that's going to ultimately apply. Now, unlike the gift and estate taxes, there's no progressive tax brackets for the GST tax. Instead, it simply has a flat rate of 40%, and that flat rate is whatever the highest gift and estate tax rate might be. And that rate is ultimately affected by the application of a GST exemption, which is equal to the estate tax exemption of $11.7 million for 2021. Now, the use of that exemption for estate or gift taxes doesn't affect the amount of the exemption available for the GST tax, and vice versa. Now, the rate of 40% is reduced, but not below zero, by the ratio of the exemption that you apply to a transfer compared to the taxable value of the transfer. Now, as I mentioned in a number of previous episodes, there's various ways you can apply that exemption, and it's applied automatically, or it could be done manually, or not at all. But essentially, that ratio is going to drive what your tax rate is. And what that does is it allows you to eliminate GST tax on the appreciation of assets until those appreciated assets are once again subject to a gift tax or to an estate tax through gross estate inclusion. And the same gift tax exclusions that we saw earlier also apply, such as present interest annual exclusion gifts and direct payments of medical and tuition expenses. So with the gift tax, when you use your GST exemption, it's not going to reduce your lifetime gift tax exclusion and vice versa. But there's an ordering here. In the rare event you have to pay gift tax and GST tax out of pocket, the GST tax will apply first. So the gift tax will apply both to the amount of the gift and the amount of the GST tax paid. That is because gift tax is tax exclusive. So even though, as we talked about with the gift tax, the donor's payment of gift tax doesn't generate an additional gift tax itself, that's not the case here. The donor's payment of a GST tax would generate additional gift tax. Now, the GST tax that's paid and or applied has to be noted on the gift tax return, Form 706. There's no standalone form for the GST tax unless there's a taxable termination or a taxable distribution. We'll talk about those another time. But it's important to note that even though you can use crummy powers on the gift tax side for annual exclusion gifts, they don't apply in the same way with the GST tax. That's also a subject for another time. And it's also important to note as well that intervening gifts can wipe out a previous GST exemption allocation if the outcome benefits skip person with respect to the person who's treated as making the gift. Some examples might be, mentioned in crummy powers, if you have a general power of appointment or a power of withdrawal that lapses in a taxable manner. In other words, the amount of that exceeds the greater of 5,000 or 5% of the appointable assets could be subject to GST tax upon that lapse. A non-qualified disclaimer creates not only gift tax liability for the disclaimant, but could also create GST tax for the disclaimant as well. Then finally, if you have a lifetime special power of appointment, usually that wouldn't by itself be a taxable type of power of appointment, but if you actually exercise it over an economically determinable trust interest, such as a mandatory income distribution or a life estate or an annuity or unitrust interest, that's also a gift that could also be subject to the GST tax. Then when it comes to the estate tax, once again, use of the GST exemption doesn't reduce the available basic exclusion for estate tax purposes and for purposes of the applicable credit, and vice versa. Now, one important feature of the estate tax I mentioned yesterday is that the unused exclusion of a deceased spouse can be preserved for the survivor, but that only applies to the estate tax exclusion. It does not apply to the GST exemption, so as of now, there's no way for a deceased spouse to preserve his or her unused GST exemption for the survivor. Now, much like with the gift tax, any GST paid and GST exemption that's applied is reported on the estate tax return, Form 709. Then finally, much like with the gift tax, any application of the estate tax to GST exempt assets will reset the allocation of that GST exemption and will require the use of the decedent's GST exemption, but dependent on the favorable shifting down of generations. So if the decedent in this case has no skip persons below them or benefited under their estate plan, this is really of no consequence unless skip persons could benefit in the future. So some examples might be where if a decedent held a general power of appointment at death, or exercised a special power of appointment to trigger the Delaware tax trap. Another situation might be where a decedent releases a general power of appointment during life but retains an interest under Code Sections 2035 through 2038. And then finally, if you have a decedent who was the beneficiary of a marital trust or life estate that had a Q-tip election that was made for gift or estate tax purposes, but which didn't have a reverse Q-tip election made for GST tax purposes. In any of these cases, the decedent would be treated as the transferor for GST tax purposes, even if the transfer was GST exempt prior to the decedent's death. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.